In this video, we are looking at the income statement, and in particular, we are looking at ratio analysis and measures of profitability. There are four measures of profitability and returns that we can derive from the income statement. They are the gross profit margin, the profit margin, the return on equity, and return on total assets ratios. This video, we're going to focus on the gross profit margin. The gross profit margin is calculated by dividing the gross profit by net sales. And net sales refers to a trading entity. If you have a sales entity, then it's simply net revenue. It's expressed as a percentage. The gross profit margin is the margin of profit available to cover operating expenses and show whether the markup of stock is sufficient to generate enough overall profit for the business. Okay, so with a trading entity, you'll buy stock in and mark it up and sell it, and you need to know if that markup is going to be enough to cover not just the costs of the purchases, but also your operating expenses, and to leave enough to turn a profit. A high gross profit margin allows the business to cover all their expenses and to earn a reasonable profit. It's fair in business to be able to earn a reasonable profit. If you're not earning a reasonable profit, you really need to do something about it. You need to adjust something, change something, find out what's going wrong, what can be improved, what can be cut back so that you can earn a decent profit. We say a reasonable profit there because if you are earning an unreasonable profit, well, that's okay, but economic forces will allow other businesses to come into your industry and soak up some of that extra profit, and your profit will be reduced back to what's called an economic profit, which in accounting parlance, let's call that simply a reasonable profit. And provide a satisfactory return to investors, whether we're talking about a private company, a small business, or a public company. Every investor wants their pound of flesh. They want the best return on their money. Otherwise, they will have the choice to take their investment out of the business, out of the company, and put it somewhere else where they can get a better return. A low gross profit margin means that not all your expenses may be covered. There may be a net loss, and investors may not receive a satisfactory return. And if they aren't confident with the future moving forward, again, they may take their money, take their equity out of the business and put it somewhere else where they can find the return that they are looking for. Let's have a look at calculating the gross profit margin now. This example, we want to calculate the gross profit margin at the end of the accounting period. Eden Enterprises has net sales of $80,000, COGS of $45,000, other operating expenses of $30,000, and the gross profit margin is determined by dividing the gross profit by the net sales. And the gross profit is net sales minus COGS, 80 minus 45, which is 35, divided by 80,000, gives us a gross profit margin of 43.8. Monaro Markets over here has sales of 100,000, sales returns of 5, COGS of 60, and other operating expenses of 15. The gross profit margin is calculated by dividing the gross profit by net sales. Gross profit is sales less sales returns less COGS. 100 minus 5 minus 60 would be about 35 as well still. And the the net sales is 100 minus 5 minus the sales returns. So that would be 35 on 95, gives us a gross profit margin of 36.8%. What observations can be made if the industry standard is 40%? Assuming, of course, that both these businesses are in the same industry, Eden Enterprises has a gross profit margin of 43.8%. This is above the industry standard. It's therefore favourable. And because it's favourable, we can say that remedial measures appear unnecessary. Further, we can say that Eden enterprises are efficient at generating gross profit from their net sales. Monaro Markets, on the other hand, has a gross profit margin of 36.8%. That's below the industry standard and therefore considered unfavourable. We would say that remedial measures would be appropriate, as Monaro Markets are not as efficient at generating gross profit from their net sales, at least compared to Eden Enterprises or even the industry standard. When commenting on the profitability of the business, it's useful to define the terminology that we are using, describe the ratio, comment on the results or the trends if we are going over 3 accounting periods, analyse the impact on the business if needed, and then recommend strategies to improve this ratio if they are required. So let's now make a comment on the profitability of Eden Enterprises. We will say gross profit margin indicates the margin of profit available to cover other operating expenses and show whether the markup of stock is sufficient to generate enough overall profit for the business. That there is the definition of gross profit margin. Then let's state the industry average. The industry standard is 40%. Eden Enterprises has a gross profit margin of 43.8%. This says that Eden Enterprises generates 44 cents of gross profit for every $1 of sales. So I've just rounded that 43.8% up there to 44, which is 44 cents of gross profit for every $1 of net sales. This is considered favourable. No remedial action appears necessary. And that's how you might comment regarding the gross profit margin of a business. Let's now have a look at Monaro Markets. First, we're going to state the definition again. Gross profit margin indicates the margin of profit available to cover other operating expenses and show whether the markup of stock is sufficient to generate enough overall profit for the business. The industry standard is 40%. Monaro Markets has a gross profit margin of 36.8%. This says that Monaro Markets, generates 37 cents of gross profit for every $1 of net sales. I've just rounded that 36.8% up to 37 because that's what it's saying, 37 cents of gross profit for every $1 of net sales. This is considered unfavourable as is below the industry standard. Remedial action appears necessary. May want to look at ways of increasing total sales, decreasing sales returns, and decreasing the cost of the goods sold. Those 3 measures will improve the gross profit margin, and they come directly from the income statement and the calculation of the gross profit margin. What stakeholders would be interested in using the gross profit margin when assessing the income statement? Well, owners and managers would be. They want to calculate and determine the efficiency and profitability of the business. They want to monitor performance by comparison against past performance. Competitors, key performance indicators, which is the industry standards and the industry benchmarks. The economic decisions of owners and managers might be a selection of appropriate strategies to improve profitability by increasing income and reducing expenses. Also, strategic decisions about business growth or diversification. There's some of the reasons, the economic decisions that owners and managers would want to use the gross profit margin when using the income statement. Also, shareholders and potential investors. They want to use profit and dividends payments to calculate and compare return on investment against other companies and investment options. So just that as the gross profit margin is one of those ratios that they can use to analyse the profitability and performance for shareholders and potential investors. Their economic decisions that they would be looking to make would be to buy, sell, or hold shares or interest in a business, and to evaluate whether the board of directors are performing their role within good corporate governance. Further stakeholders are lenders and creditors. They would want to analyse the business's expenses and profitability. They would look at their gross profit margins and to determine risk of providing credit, to set appropriate interest rates for loans provided to the business, and assess its ability to repay existing loans. Remember that gross profit margin looks at its ability to cover other operating expenses, and interest on loans falls into those other operating expenses. Employees would want to know something about the gross profit margin so they can look at the income statement and determine the profit for individual departments and overall profitability of the business.